Pepe might be lining up its next big move. According to Crypto.news, price has pulled back into a dynamic support zone that has been respected since the March low, while the broader structure still shows higher highs and higher lows. That kind of retest often decides whether bulls have the energy to launch a fresh leg up. Here's the setup traders are watching. The article explains that Pepe is compressing between a rising trend line and a heavy volume area, known as the point of control, which is acting as near-term resistance. When price gets squeezed between rising support and a major volume node, it creates an apex where the next break tends to travel fast. Now the bull case. Crypto.news notes the market structure remains constructive. Every dip into ascending support has produced a higher low, and rebounds have pushed to higher highs. If buyers can reclaim the point of control with expanding volume, the playbook is a rotation toward the prior swing high, and momentum can extend if participation keeps building. What would actually confirm strength from here? The article highlights 3 tells. First, a decisive daily close back above the point of control. Second, rising volume on the breakout rather than a thin push. Third, the higher low pattern continuing right off that dynamic support. When all 3 line up, probabilities favor trend continuation. There is a bear case too. Crypto.news points out that repeated rejections at resistance show supply waiting at the point of control. If Pepe loses the dynamic support on a closing basis and volume accelerates against it, that opens the door to deeper corrective pressure and invalidates the immediate breakout idea. In simple terms, that rising support is the line in the sand. How to think about it in practice? The article suggests treating the range like a decision box. Inside the box, expect chop and be patient. A clean move above the box with volume favors a bullish rotation toward the recent high. A strong move below the box argues for waiting until a new base forms. If you are managing risk actively, think of support as defense, the point of control as the gate, and the swing high as the target. Participation matters. Crypto.news emphasizes the volume profile because the point of control is where the most trading has occurred. Reclaiming it means the crowd is willing to accept higher prices again. Confirmation improves when spot volume and open interest expand together during the move. What to watch this week? First, the interaction with that rising support. Do intraday wicks dip below and close back above, or do daily candles settle underneath? Second, the first retest after any break. Quality breakouts often retest the level they cleared and then hold it. Third, behavior at the prior swing high. That is the usual profit-taking zone. If price pushes through it with firm volume, it signals trend strength rather than a simple range tag. All 3 checkpoints come from the structure described by Crypto.news. Risks to respect. Compression patterns can produce fakeouts before the real move. Broader market conditions matter. If the majors wobble, meme coins usually amplify the move. Keep position sizes sensible, define invalidation before you enter, and avoid chasing candles without volume. The signal here is not just direction, it is how price behaves around support, resistance, and participation. Bottom line. As reported by Crypto.news, Pepe is coiling at a familiar springboard while resistance sits just overhead. Hold the dynamic support and reclaim the point of control with real volume, and the path of least resistance is a run at the swing high. Lose that support decisively, and bulls likely need more time to rebuild the base. Is Chainlink going to be the next XRP? That's the question the Motley Fool raises in a fresh analysis comparing LINK's growing role in traditional finance with XRP's payments first momentum. According to the Motley Fool, the next XRP idea isn't about copying price action tick for tick. It's about whether Chainlink can become the default plumbing for institutions in the same way XRP has become a leading brand for fast, compliant cross-border settlement. Let's set the stage. XRP's draw is simple, near-instant, low-cost payments with increasing regulatory clarity and improving institutional access. According to the Motley Fool, that clarity plus ETF momentum and payment corridor wins keep XRP in front of mainstream investors who want a straightforward use case. Chainlink's pitch is different. Link doesn't move payments itself, it moves the data and messages that payments and tokenized assets rely on. That data and messaging layer is where the institutional story gets interesting. According to Swift's published experiment results, Chainlink's cross-chain interoperability protocol CCIP helped demonstrate how tokenized assets could be transferred across multiple public and private block chains using banks' existing SWIFT infrastructure. And according to DTCC's Smart and AV pilot report, DTCC used Chainlink to broadcast mutual fund and AV data on-chain for industry participants, showing how trusted data can feed tokenized funds and downstream brokerage apps. Put simply, the world's market pipes are testing Chainlink as a bridge between legacy systems and blockchains. Under the hood, Chainlink has been shipping. According to Chainlink's Q1 2025 review, CCIP surpassed roughly $2.2 billion in cross-chain value transferred and expanded across dozens of chains, while the network's data feeds, VRF, and cross-chain token standards kept onboarding new projects. For investors, the takeaway is that Link's demand can grow as more financial apps consume feeds and send messages across chains, whether that's for tokenized treasuries, stablecoins, or fund data. So where does the comparison land? According to The Motley Fool, XRP and Chainlink are converging on the same destination: mainstream adoption, but from different directions. XRP is the payments rail that institutions can use. Chainlink is the interoperability and data layer that institutions can plug into. If banks, custodians, and FM is scale tokenization, the argument is that Chainlink could enjoy an XRP-like institutional moment, just centered on data and cross-chain connectivity rather than retail remittances. Now the balanced view. Both assets carry risks. According to The Motley Fool, XRP's upside still depends on measurable payment volumes, continued regulatory alignment, and steady ETF inflows. Without that, price can stall. For Chainlink, the risks include competition from other Oracle and interoperability providers, the need to keep security spotless, and ongoing scrutiny of token economics and grant emissions. Neither project is a guaranteed millionaire maker, and both still track broader crypto risk sentiment. What should you watch next if you're following this story? First, concrete adoption updates. Look for more production-grade tokenization programs citing CCIP, more financial data providers pushing feeds on-chain, and new bank pilots that reference SWIFT plus Chainlink in the same breath. Second, for XRP, watch payments metrics, order volumes, enterprise partnerships, and any additional ETF or custody integrations that make allocation easier. Third, track how each asset behaves around catalysts. Does rising usage show up in on-chain activity, exchange liquidity, and sustained price strength, or is it just headline drift? Here's the bottom line. According to The Motley Fool, is Chainlink going to be the next XRP? Is really asking whether Link becomes the institutional backbone for tokenized assets, the way XRP has become a flagship for compliant crypto payments. If tokenization and cross-chain finance keep accelerating, both can win: XRP at the settlement layer, Chainlink at the connectivity layer. You've been watching Cryptozard News. Please subscribe and like, and leave a comment if you enjoyed this video, and let me know what other crypto-related news you'd like to hear in the future. Is XDC gearing up for a bigger run over the next cycle? Today we're breaking down what the XDC network is, why institutions care about it, and where credible forecasts think price could go. First, the basics. The XDC network is an enterprise-grade, EVM-compatible blockchain built by Shinfin for trade finance, real-world asset tokenization, and cross-border settlement. According to the official XDC network site, it uses a delegated proof-of-stake design and positions itself as a hybrid, business-friendly chain for tokenizing invoices, letters of credit, and other financial instruments. Why the renewed interest? Tokenization is moving from pitch deck to pilot. Banks, custodians, and fintechs are testing how on-chain rails can speed up settlement and improve transparency in trade and supply chain finance. That is the lane XDC is trying to own, and it's why long-range forecasts are getting attention. Now to the numbers. According to a July 4, 2025 roundup from the StealthX research blog, 2030 projections vary a lot depending on the model. Digital coin price sits on the conservative end, with an estimated 2030 range around 29 to 33 cents and an average near 32 cents. Price prediction is more optimistic, with a band roughly between 50 and 59 cents and an average a little above 51 cents. And then there's Telegaon, which is extremely bullish in that same StealthX roundup, floating a 2030 range between about $3.97 and $5.65. That spread from cents to multiple dollars tells you how uncertain long-term adoption and token economics still are. StealthX also compiles far-out scenarios that some sites publish for 2040 and 2050. Price predictions distant horizon posts cited by StealthX suggest figures in the tens of dollars by 2040 and even higher by 2050. Treat those as speculative moonshots, not base cases. They assume global tokenization at scale, steady enterprise demand, and years of execution without major setbacks. So what would need to happen for the middle path to play out? According to StealthX's overview and the XDC network's own positioning, 3 drivers matter most. 1. Real production volumes in trade finance tokenization, not just pilots. 2. Easier institutional access, custody, compliance, and liquidity so larger buyers can hold XDC alongside tokenized assets. 3. Steady developer activity that keeps fees low and uptime strong while apps ship on-chain. Let's balance this with risks. Enterprise blockchains live or die on integrations. If banks decide to standardize on other L1s or rely on private ledgers with tokenized claims settled off-chain, XDC's share could be smaller than the bulls expect. Competition is intense, regulation can slow onboarding, and token unlocks or treasury decisions can weigh on price. The wide forecast spread compiled by StealthX is a reminder to size positions with caution. What should you watch in the coming quarters? Track tangible metrics, new tokenized programs that actually settle on XDC, growth in active addresses tied to business flows, and exchange liquidity that makes larger tickets possible. Also watch for partnerships that connect XDC into custody, fund admins, and trade finance platforms. If those pipes harden, the conservative forecasts look achievable. If they stall, the conservative end becomes the ceiling. Bottom line. According to StealthX's 2030 roundup, credible models cluster between roughly 30 and 60 cents, with one outlier in the multi-dollar range. According to the XDC network site, the thesis is enterprise tokenization and trade finance, so the price path will follow real adoption. Keep an eye on production-grade deals, not just headlines, and let the data guide your expectations. You've been watching Cryptozard News. Please subscribe and like, and leave a comment if you enjoyed this video, and let me know what other crypto-related news you'd like to hear in the future. Ripple's stablecoin strategy is accelerating, and it could reshape how XRP fits into the ecosystem. According to Yahoo Finance, there are 4 big things investors should know right now about Ripple, XRP, and stablecoins. First, Ripple now has its own dollar-pegged stablecoin. According to Yahoo Finance's coverage of the launch, Ripple introduced Ripple USD, ticker RLUSD, in late 2024 as a cash and cash equivalent-backed token designed for payments and settlement. A live RLUSD page on Yahoo Finance shows hundreds of millions of tokens in circulation at a $1 peg, which signals real traction rather than a pilot. Second, Ripple is partnering rather than going it alone. According to a recent Yahoo Finance piece, Ripple teamed up with Circle in June to bring USDC deeper into the XRP ledger. That partnership matters because USDC is already widely used by exchanges, fintechs, and payment processors. If USDC roots natively on XRPL, liquidity improves for developers and market makers, and it becomes easier to build consumer-grade apps without leaving Ripple's rails. Third, Ripple is buying infrastructure to move faster. According to Yahoo Finance, Ripple agreed to acquire Rail, a Toronto-based payments platform, in a deal valued around $100 million. That purchase is aimed at scaling stablecoin-powered payouts and merchant flows. Put simply, Ripple is not waiting for third parties to stitch things together. It is buying the pipes and plugging stablecoins directly into them. Fourth, and this is the nuance, stablecoins are a natural fit for Ripple's enterprise payments business, but they may complicate the investment narrative for XRP. According to a Yahoo Finance analysis headlined Ripple and stablecoins for things investors need to know. Stablecoins can handle value transfer with a stable unit of account, which corporates like. That raises a fair question for XRP holders. If more payment flows settle in our LUSD or USDC on XRPL, does that complement XRP by growing total network activity? Or does it cannibalize demand for XRP as a bridge asset? The most likely answer is that it depends on the corridor. In volatile or thin markets, a highly liquid token like XRP can still act as the bridge. In mature dollar corridors, a stablecoin may be the simplest option for treasury teams. Either way, more throughput on XRPL tends to improve liquidity, spreads, and developer interest, which can be positive second-order effects for the whole stack. So what should you watch over the next few months? According to Yahoo Finance's reporting, 3 signals matter. 1. Are LUSD supply and usage on XRPL. If the supply climbs steadily while on-chain transfers rise, that shows genuine adoption. 2. USDC activity on XRPL following the Circle partnership. If USDC volumes lift and developers integrate it into wallets and merchant flows, that validates the multi-stablecoin play. 3. Ripple's execution on the rail acquisition. If merchants and payout partners start quoting stablecoin rails by default, that is a sign the payments product is landing with real customers. There are risks to weigh. Stablecoin regulation is tightening globally, and compliance obligations can increase operating costs. Liquidity can fragment across multiple dollar tokens if governance is not coordinated. And for XRP specifically, the market will be watching whether payment growth translates into measurable XRP demand, not just stablecoin settlement on XRP ledger. Here is the bottom line. According to Yahoo Finance, Ripple's stablecoin push has 4 pillars right now. Launch a fully backed dollar token. Partner with the biggest existing stablecoin network by payments infrastructure to scale, and thread the needle so that stablecoins expand XRPL utility without sidelining XRP's role as a bridge asset. If Ripple executes, payments volume on XRPL grows, and the ecosystem becomes more attractive for builders and institutions. If execution stalls, stablecoin activity could live elsewhere, and the opportunity narrows. You have been watching Cryptozard News. Please subscribe and like, and leave a comment if you enjoyed this video, and let me know what other crypto-related news you'd like to hear in the future. Is Ethereum picking sides? Vitalik Buterin says absolutely not. According to Crypto.news, Vitalik just reaffirmed that Ethereum should behave like a dumb pipe at Layer 1, processing all valid transactions without discrimination, and he outlined a path to make that neutrality much harder to break. So what changed? According to Crypto.news, Vitalik floated a framework called Fossil that would change how transactions get included in each block. Instead of a single proposer per slot, FOCIL assigns 17 proposers to every slot. One proposer still moves last and chooses final ordering, but the other 16 get to submit transactions that must be included somewhere in that block. The idea is simple. Don't let any single block builder or pair of builders veto what goes on-chain. Why push this now? According to Crypto.news, a handful of professional builders dominate block production today. If those builders or the relays they rely on coordinate to filter certain transactions, censorship becomes possible in practice even if it's not written into the protocol. FOCIL spreads the power to include transactions across many hands so that even if two big builders control most blocks, they still can't exclude a valid transfer. Vitalik also lays out 3 lines of defense for neutrality. According to Crypto.news, the first is to keep the public mempool strong so validators can always build blocks naively from public transactions. The second is to keep investing in distributed block building tech outside the core protocol so there isn't a single choke point for block creation. The third is to add extra inclusion channels like Fossil so there are multiple ways a valid transaction can make it into a block, even if the primary builder says no. Not everyone agrees on the trade-offs. According to Crypto.news, Amin Soleimani warned that forcing inclusion could raise legal risks for US validators if a transaction touches a sanctioned address. His concern is that neutrality at the protocol level might collide with jurisdictional rules at the validator level. Vitalik's counterpoint is that neutrality is the point of a base layer, and that Ethereum should prioritize designs where lawful users aren't blocked because a few intermediaries decide to filter. How would this feel for users and validators? In the best case, wallet sends keep working normally even during politically sensitive moments because there are many inclusion paths per slot. Validators who aren't the final last mover still have a lightweight role. They validate and propose a set of transactions to include, which can be run statelessly and doesn't require heavy machinery. Over time, Vitalik suggests the same principle could extend to things like smart contract wallets or withdrawals from privacy protocols so that no single operator can quietly prevent you from moving funds. There are real questions to answer. Extra inclusion roles add coordination complexity. Client teams would need to implement and test the new proposer logic. Networks would need to measure overhead and latency. And there's the policy reality. Validators and operators still live in jurisdictions with rules. Protocol neutrality doesn't erase legal obligations, so operators may need clearer guidance on what must include means when sanctions are involved. What should you watch next? First, the research and developer discussions. Does Fossil get a formal proposal number, testnet experiments, and client prototypes? Second, builder and validator reactions. Do major operators say this is feasible and worth the trade-offs? Third, wallet UX. Do leading wallets and relays plan for multi-proposer inclusion so the user experience stays smooth if the network adopts this path? Bottom line, according to Crypto.news, Vitalik's Fossil framework is about hardening Ethereum's neutrality so no single builder, relay, or cartel can quietly decide who gets to transact. If it advances, Ethereum becomes more censorship-resistant by design. If it stalls, the network may continue relying on social pressure and patchwork workarounds whenever builder centralization becomes a problem. You've been watching Cryptozard News. Please subscribe and like, and leave a comment if you enjoyed this video, and let me know what other crypto-related news you'd like to hear in the future. One in four Brits are now open to owning crypto. According to Yahoo Finance, a new UK survey suggests roughly a quarter of adults would consider adding digital assets, some even in their retirement planning. That's a big sentiment shift, and it has real implications for how crypto fits into everyday finance in the UK. Let's unpack what's driving this. The survey, as reported by Yahoo Finance, points to three main motivations: the potential for higher long-term returns than cash, diversification beyond traditional stocks and bonds, and curiosity after seeing Bitcoin and Ethereum go mainstream. Interest is strongest among younger adults, but awareness is now broad across age groups. So what are people actually looking to buy? Based on the patterns highlighted in the report, most would start with large caps like Bitcoin and Ethereum, followed by stablecoins for payments and transfers. A smaller share is curious about staking yields and tokenized funds, but the appetite there depends on how easy and regulated those products feel on UK platforms. If you're in the UK, here's the reality check. Crypto remains a high-risk investment. It's outside FSCS protection, prices are volatile, and fraud risk is real. That's why the #1 theme in the Yahoo Finance piece is caution coupled with education. Before you put a pound in, decide your maximum allocation, know your time horizon, and choose a reputable platform that follows UK rules. Let's talk retirement, because that's the eyebrow-raising part of the survey. Some respondents said they'd be open to crypto in long-term savings. In practice, most workplace pensions won't offer direct crypto yet. The more realistic near-term path is indirect exposure. Think listed crypto ETPs where eligible, or simply holding a separate, modest crypto allocation alongside your pension. The principle is the same: small, deliberate, and long-term. A quick UK-specific checklist if you're thinking of dipping a toe in. 1. Set a cap. Many disciplined investors limit crypto to 1 to 5% of investable assets. 2. Use pound cost averaging. Small, regular buys reduce the stress of timing. 3. Stick with reputable, UK-compliant platforms and enable strong security, including two-factor authentication and withdrawal allow lists. 4. Understand custody. If you self-custody, learn hardware wallet best practices. If you leave assets on an exchange, know the risks. 5. Track taxes. HMRC treats most disposals as capital gains events. Keep records of deposits, trades, and withdrawals. There are also red flags to watch. If a platform promises guaranteed returns, walk away. If someone urges you to move savings or pension money urgently, slow down and verify. If an investment relies on referrals, bonuses, or opaque yield strategies, assume the risk is higher than it looks. Zooming out, the survey's 1 in 4 headline lines up with a broader UK trend: adoption inching higher each year as products, education, and rails improve. The big swing factors from here are policy clarity on stablecoins and tokenization, bank integrations that make on and off ramps smoother, and whether mainstream brokerages offer simpler, regulated routes to exposure. Bottom line. According to Yahoo Finance, UK openness to crypto has reached a meaningful threshold. That doesn't mean go all in, it means more people are considering a small, thoughtful allocation as part of a diversified plan. If you decide to participate, treat crypto like venture-style risk, size it modestly, and give it time. You've been watching Cryptozard News. Please subscribe and like, and leave a comment if you enjoyed this video, and let me know what other crypto-related news you'd like to hear in the future.